Every year, millions of households pour thousands of dollars into items that look like ordinary purchases but actually operate as tribute. Not theft tribute. The money exits your account with your full consent, your signature, and often your genuine gratitude, only to land on the balance sheets of industries that have spent decades engineering the exact psychological conditions to make you say yes. Most people believe wasted money stems from personal weakness, impulse buys, emotional decisions, or insufficient. That view is mistaken. The true waste is structural and deliberate. These 12 categories were carefully architected by behavioral economists, actuaries, and lobbyists to pull maximum value from otherwise rational, careful people. And one of them has transferred more middle-class wealth than every stock market crash over the past 50 years combined. We'll reach it soon. Number 1. New electric vehicles. For decades, driving a new car off the lot meant accepting the same harsh reality. An instant 20% loss in value. Everyone understood it as a predictable penalty for impatience. Electric vehicles were marketed as the exception, government subsidies, glossy commercials featuring mountain roads and ocean views, and the promise of early adopter prestige framed them as responsible investment and the future on wheels. Yet the reality told a different story. According to data, several EV models have lost between 40 and 55% of their market value within the first 3 years. A $55,000 vehicle can list for just $24,000 on the used market after 30 months. The battery still functions, and the range remains adequate. The issue is technology obsolescence on an automotive scale. Battery chemistry advances every 18 months. New base models arrive with superior range and charging speeds at lower prices. The used 2022 EV now competes directly against a cheaper 2026 entry-level model. It mirrors the iPhone upgrade cycle, except your iPhone does not cost $55,000 or require a $12,000 specialist battery replacement. Factor in insurance premiums that run 20 to 30% higher than comparable gasoline vehicles, plus home charging installation, and the rising cost of public fast charging as free promotion periods expire. The Roman denarius under Emperor Caracalla still looked like a Roman coin. Same size, same seal, but half the silver had been quietly stripped away. Owners discovered the debasement only when the market revealed it. The 2022 EV buyer is receiving the same message today. In 2026, the rational choice is clear. Purchase a 2 or 3-year-old used model where depreciation has already been absorbed. Technology is comparable, and prices sit 35 to 45% below original retail. Let someone else subsidize the future. Number 2. Whole life insurance. Before dismissing this one, consider the precise mechanism at work. This is not merely criticism of individual insurers. It is an examination of one of history's most effective wealth transfer systems, consistently sold as the responsible option. Term life insurance is straightforward. Modest premiums provide a payout if you die during the coverage period. If you outlive the term, the policy ends cleanly and cheaply. Whole life fuses that protection to an investment component, permanently controlled by the insurance company. The pitch sounds appealing: cash value that grows tax-advantaged. An asset for your children. Protection that works while you live. Every statement is technically true. Every implication is financially ruinous. The internal rate of return on the cash value portion of the average whole life policy hovers between 1 and 2% annually over the first 20 years. In the same period, a low-cost S&P 500 index fund has averaged 10 to 12%. The monthly premium gap between whole life and equivalent term coverage for a 35-year-old can reach $300 to $600. Invest that difference at a conservative 9% annual return over 30 years, and the result is generational wealth. The U.S. life insurance industry collects roughly $600 billion in annual premiums, with permanent products forming a disproportionate share. Sold heavily to middle-income families told they were building something. In Weimar, Germany, the middle class did not lose savings in one dramatic collapse. They watched them erode slowly inside trusted institutions using professional language and calm assurances, while compounding math worked against them. Whole life operates on a 30-year horizon. The damage accumulates silently. Buy term and invest the difference in a low-cost index fund. This truth is no secret among financial professionals. It is simply withheld from their clients. Number 3. Actively managed mutual funds. The sales story is compelling. Teams of credentialed analysts armed with real-time data and proprietary models work tirelessly to outperform the market, justifying their fees with superior results. The data tells another story. The S&P Indices versus Active report found that more than 90% of actively managed large-cap funds underperformed their benchmarks after fees, not occasionally, consistently over 2 decades. Average actively managed equity funds charge 0.5 to 1.5% annually. Comparable index funds charge 0.03 to 0.1% on a $100,000 portfolio compounding at 8%. The fee gap alone erodes more than $80,000 over 30 years. Eugene Fama's Nobel-winning research demonstrated that yesterday's outperforming manager is statistically no more likely to repeat next year. The industry marketed the myth of the gifted stock picker for decades. The structure is elegant. The manager earns a percentage regardless of outcome. Heads they win, tails the investor loses, and the manager still collects. A 20-year record of majority underperformance reveals that the product is not outperformance. It is the fee itself, wrapped in professional language sold to people who trusted expertise to deliver results. Number 4. Extended warranties. The moment you purchase a refrigerator, television, car, or laptop, the warranty pitch begins. Retailers earn 50 to 70% margins on these plans. In some electronics stores, protection plan profits exceed those of the products themselves. Consumer studies show extended warranties deliver poor expected value. Failures cluster either inside the manufacturer's free warranty or long after the extended coverage expires. Products are engineered to outlast the standard window. The industry runs on probability arbitrage, with actuaries ensuring the math favors the seller. A $1,000 emergency fund provides real protection. It earns interest, never expires, and covers repairs without hunting for paperwork. Number 5. Credit life and debt protection insurance. These products slip quietly into auto loans, personal loans, and credit card agreements. They promise to cover payments if you die, become disabled, or lose your job. CFPB investigations reveal loss ratios below 40%, far worse than standard life insurances, 70+%. For every premium dollar collected, less than 40 cents returns in claims, often added by default during rushed closings with minimal disclosure. These plans generate billions in hidden revenue. Review every loan document carefully. The cost rarely matches the protection received. Number 6. Premium gasoline for standard engines. The pump offers regular, plus, and premium. The word premium implies superiority. AAA testing confirms that for vehicles without high compression engines, designed for high-octane fuel, premium delivers zero benefit, no better mileage, no extra protection, no performance gain. If your owner's manual says recommended rather than required, regular fuel performs identically. American drivers waste an estimated $2 billion yearly on unnecessary premium gas. Number 7. Bottled water. In 1976, Perrier reframed free municipal water as a luxury. Today, the global market exceeds $400 billion. EPA rules demand daily testing of tap water. FDA oversight of bottled water is far lighter. Independent tests show many brands repackage municipal supplies at 1,000 to 3,000% markups. A home filter costing $30, $200 produces chemically identical water, 4 pennies per liter. The industry convinced society to buy, bottle, and discard something that falls from the sky. Number 8. Timeshares. Marketed as vacation ownership and inflation protection, timeshares resell. But industry data 0 to 10% of original price or not at all. Owners often pay thousands to exit companies to escape perpetual contracts. Maintenance fees average $1,200 yearly and rise indefinitely, transferring to heirs. An entire exit industry thrives solely on helping people flee the very product they bought. Number 9. College degrees with negative ROI. Georgetown University research shows graduates in fine arts, social work, certain humanities, and some education fields earn less over their first decade than skilled trade workers who finish apprenticeships debt-free in 3 to 4 years. U.S. student debt surpasses $1.7 trillion. Average 4-year debt hits $38,000. while some graduate degrees exceed $100,000. A certified electrician earns $62,000 SAT, $1,000 median salary quickly and debt-free. A master's level social worker earns roughly $58,000 after 6 or 7 years of schooling and heavy borrowing. Institutions and lenders profit regardless of outcomes. Run the numbers before signing. Number 10. The lottery. With an expected return of roughly 50 cents per dollar, the lottery is a voluntary tax. On weak statistical intuition, it sells a 24-hour daydream, not a financial product. Lower-income households spend about 6% of income on tickets, more than on some groceries, while state budgets treat lottery funds as net neutral for education. The architecture extracts from those least able to afford the odds. Number 11. Organic premiums. On the wrong products. The Environmental Working Group's Dirty Dozen lists items where organic reduces real pesticide exposure. The Clean 15 shows thick-skinned produce like avocados and pineapples, where conventional options have negligible residue. Organic premiums on processed snacks mainly by marketing language, not meaningful nutrition. Choosing wisely saves the average household $1,500, $2,000 yearly. Number 12. Subscription services you don't use. A 2025 West Monroe study found households underestimate monthly subscriptions by $133, believing $86 but actually spending over $219. The model exploits cancellation friction. The global subscription economy exceeds $1.5 trillion by design. Easy to join, hard to quit. A 30-minute quarterly bank statement audit yields the highest return on time available to most families. All 12 share one thread. None arose randomly. Each was engineered with precision by experts who mastered behavioral economics, probability, cognitive load, and compounding. Far better than the buyers. The psychologists who crafted the warranty pitch studied literature most consumers never read. The actuaries pricing whole life policies understood compound interest better than the 35-year-olds signing the forms. You did not waste money through carelessness. You stepped into optimized systems without a map. The ancient Roman merchant accepted debased coins because he lacked the knowledge to detect the hidden removal of silver. That knowledge was deliberately withheld. Now you hold the test. The only remaining question is whether awareness will alter behavior, or whether the architecture of inertia, automatic payments, trusted salespeople, and the comfort of doing what everyone else does will prevail again next month. That is not rhetorical. It is the only question that matters.